Hello and good afternoon. I welcome you to today's hot topic webinar, the best oil ETFs in 2021. Let me just open the chat box here, just see that. Yes, so hello, it's pretty nice. So let me just open also here the YouTube stream. So right now, it's not just that you can ask your questions in real time in the chat box here within the Zoom software, but also you can ask all your questions here on YouTube. And let me just type in hello traders here. So this is where you can also ask all your questions around the upcoming 45 minutes and the topics we cover here, and everything here in this context, what we will discuss. So oil is obviously right now a quite hot topic with the recent bull run. Some of you, well, we will look at it here in the upcoming minutes. Probably remember April 2020, yes, April 2020 with negative oil prices. So what happened there? What was the main driver? What's the current driver higher? So no big surprise here, in my personal opinion, at least. And so, yeah, this is everything what we will cover, what we will look at here in the upcoming 45 minutes. If you follow here the video, the recording right now, or the live event on YouTube in the stream, then please leave a thumb up here if you like what you will see. Subscribe to the YouTube channel. Also set a reminder to not miss any of the videos which we are producing here for you in the trading community. And so that's it around the short introduction. Here I will now share my screen. There we go. And then we have it, best oil ETFs in 21. And so we will first of all here have a look at the current rebranding, which is taking place at Admirals, the broker, which is making all this possible here so that you can get this input for free. Admirals, you probably have heard about this broker before, Admiral Markets in this context. And the broker here is currently seeing a rebranding. So Admirals is in fact known as a well-established FX and CFD broker since 20 years. So 2001, they started their business and have global presence around the globe. So we have this one world, one broker approach in this context. And beside of that, we also have one of the not just most regulated brokers in this industry, but in addition to that, also a true expert when it comes to active trading and day trading in this context. Here in Germany, for example, we usually refer to Admirals as the so-called DAX expert with the I don't know any broker, to be honest, who has a more competitive offering. Also, not just in terms of trading conditions when it comes to tightness of spreads, but also order execution speed when it comes to executing the order. And so all that said, and probably you have already the demo. If not, go to admirals.com for download the demo. You will see that you will have here to log into their traders room, where you can download all tools like Trader Platform, Supreme add-on, and so on and so forth. And there you have, for example, also a wallet function. So you can have a gold wallet, for example. Right now, Admirals is also thinking about here going crypto in this context. So putting some of your funds in the crypto space. There's at least developments going on right now. The latest introduction here, and this is also where the rebranding comes into place and where Admirals is also establishing itself as a true multi-asset broker, is the so-called, or not so-called, but it's a credit card. It's a credit card where hopefully when you make money trading the markets, you can deposit your funds from your trading account into your credit card and then pay your whatever you might pay there with your Admirals credit card. So make long things short, the current rebranding taking place is that you not just have a trading broker, but you also have a true expert when it comes to multi-asset brokerage, when it comes to physical stocks, for example. And now it's also going the way into the financial services around credit cards, for example, and so on and so forth. And so check out admirals.com for further information. Here's the one world one broker approach. Probably one last thing I'd like to add here in this context. So I started in a bank as a clerk, and I had direct contact with clients there. And what I can say is that sometimes there was an international public or international people there, not being native German speakers in this context. And so that being said, having some trouble sometimes understanding what we were discussing, and so they felt more comfortable if we were talking to them in their native language. And this is something which here is also one point which is outstanding when it comes to Admiral as a broker, also having now a not just Jordanian, but Jordan license, for example. So a license is fully regulated, but also offices around the globe with plenty of other languages. Then it's not just English and German, but also English is above and beyond that. And so that might be another reason to give Admiral a deeper look. Also, social media, follow us on Instagram. Also here at YouTube, you subscribe to the YouTube channel already. If you're on Instagram, then check out here the offering there too. And that's it around the introduction. So now let's have a look at today's agenda and what we want to focus on. So first of all, I'd like to give a short recap here on what are ETFs, since we're not necessarily or only talking about oil and looking here at the overall global macro picture, but we also want to shine a light here on a more diversified way to invest in oil, also from a longer term perspective. Some of you probably not just have wondered if there is some opportunities here in regards to trading, which is obviously the case. So trading oil CFDs, for example, but also thinking about being unleveraged in this context and invest here in longer term assets in this case, or longer term, we're looking at a longer time frame and looking at assets which offer some opportunity to invest, fulfill the needs here for longer term investment in this context. And that's one of the reasons why we want to have a look here at ETFs, what they are, what ETF stands for. And I also want to point out some advantages. And then I want to give you an overview of some of probably the top three, at least in my personal opinion here, oil ETFs, which you can also find then when trading with Admirals and here under their multi-asset brokerage offering, not just from a trading perspective, but also from a pure investment opportunity unleveraged via their invest solution. So let's have a look here. First of all, the question: what are ETFs? Short recap to give some thoughts on this here. And so first of all, ETF is short for exchange traded fund. I'm sorry, not product, but exchange traded fund. And this is what we talk about here is a group of securities here you can buy or sell via a stock exchange. Obviously, we have an exchange, and there you can then buy and sell this ETF here with true volume, as which is a very interesting information also for some people. Some of you probably have wondered whether this is probably an important aspect which also needs to be considered when trading, actively trading. And I'd say volume is a very, very important component of your overall trading. If you can really see who's, and it's not who is buying, but if there's someone buying, if there's true buying taking place. So if, for example, a breakout occurs or something like that from a technical level, some breakouts are sustainable, some are not. Which are the ones who are sustainable, or which are sustainable, and which are the ones who are not sustainable? It's not 100%, but one good way to guess whether a break is sustainable or not is if it's underlined with true volume, with lots of volume, and thus buyers, if the breakout is on the upside, respectively sellers on the downside, step in and really start to aggressively buy, respectively sell the underlying asset in this context. So also ETFs are probably interesting for some of you more active traders, which means like we're not necessarily in this context, you're looking only and solely at the oil ETFs, but we are also looking at, for example, ETFs like the SPDR. This is the ETF on the E-mini S&P in this context, for example, S&P 500. We are looking at the Qs here. The Qs are the NASDAQ 100 ETF, for example. So it's definitely something to give it some further consideration here. If you say, I want to get access to highly liquid ETFs in this context, and also get an information, an idea around the volume which is traded at certain levels and respectively prices. And Let's come back to ETFs here. So ETFs can offer a range of asset classes consisting of a group, for example, of traditional listed companies, which is, for example, true. I already mentioned it, SPDR. So in case of the S&P 500, you take the, based on the market capitalization, biggest companies in the US, and then you put them in a basket, you get an index, and then, yeah, well, you have one opportunity. You could say, well, I trade every stock within this S&P 500, for example, in the index, which is quite, yeah, well, obviously cost intensive because, well, you have to pay exchange fees, respectively, you have to pay commission for every trade, every time you have to pay the spread. And the same is also true if you're selling these assets. Then in this context, if you have the opportunity to sell them, there CFDs come into play. You can also short sell ETFs. In this case, CFDs on the underlying ETF. And yeah, well, the thing is now that you can also give opportunity to trade here, this product, this basket, not trade every stock itself, and also calculate how much is the weight within the index then, but use an ETF in this context and trade the ETF, the basket itself then, and directly. And this is one way to do it, and or to this is the most common way. But today, what we want to do is we want to look here at ETFs, especially on commodities like oil. You can also do this certainly on currencies. Still, I have to say I haven't really heard about this, if this is really this actively traded. I could imagine there's kind of an USDX or something like that. So it's a basket, US dollar index, and then you have a certain weight of currencies which are traded against the US dollar, like euro or like the British pound, Japanese yen, and so on and so forth. But I really haven't heard about this. But what's definitely common straight after equities here, like the SPDR Qs, are definitely commodities like oil. And so what we can also or what we have observed, let's put it that way, is that ETFs have seen some heavy capital inflows since, as I already pointed out, they can be, or they offer a very attractive way, a very good way here to realize certain investment goal structures. So you might have a personal risk preference, risk tolerance in this context, and ETFs offer some great opportunities here in a quite effective and also to some extent cheap way to invest in a broad diversified portfolio of stocks, of commodities, for example. And to just give you some further details on this, on US stock exchange alone, so we are only looking at US equities here, respectively US stock exchanges, we have in fact over 1,000 listed ETFs with currently more, or around slightly more than that, I'd say, because of the massive capital inflows we've seen over the last 12 to 16, 18 months, with around 1 trillion USD being invested as of now in these ETFs, in fact. We've also talked about ETFs, by the way, so not just oil ETFs, but also or commodity ETFs in this context, as we will do today, but also in the recent past. You probably remember one of the YouTube webinars or streams here, one of the recordings. I highly recommend checking the YouTube channel here from Admirals around the ARK Innovation ETF, for example, from Katie Wood. And in this context, then her current holdings. You have also followed the recent action in Chinese ADRs, for example. So Baidu or Tao, Edu, what else? PDD or JD, for example. So these are out of the, let's call it e-commerce, but also the educational sector, for example. And the interesting thing now is, and I'd like to point this out here, because this is also showing why you should definitely think about ETFs and give them a deeper look here, or consider them into your overall trading routine. It's not necessarily a must that you need to trade them, but they give some very interesting information. For example, now let's look at the ARK Innovation ETF and then the current outflows out of Chinese ADRs. We don't want to dig too deep into the Chinese regulators right now. Here pushing for non-profit solutions when it comes to the educational sector and so on and so forth, and highly limiting the access to capital markets from these companies. But what interests us is, in this context, what does this have to do with these stocks I just mentioned? So you could also short sell them by using the CFDs being offered from Admirals in this context, for example. But the thing is now, where is the selling pressure coming from? It's not just, I mean, there needs to be someone who's selling out. And for example, the ARK Innovation ETF has some heavy holdings in these companies I just mentioned. So Baidu, Alibaba, or Baba in this case, so JD, and so on and so forth. And the thing now is that if this selling pressure hits the market then, and the ETFs lighten up here in this context, and they have strong holdings within these ticker symbols I just mentioned, well, there's naturally selling pressure happening. So if you have such a mentioned or hot, let's say, ETF, which is offered from one of the hottest portfolio managers on the street right now. And I think we all agree that in case of Katie Wood, this is the case. So she's certainly one of the most interviewed as of now, at least in my personal opinion, within the last 12 to 18 months, most interviewed portfolio manager here, managing a portfolio in case of the ARK Innovation ETF of more than 50 billion USD. Well, certainly, if she's selling out because of regulatory developments taking place in China, well, certainly this has also an impact on the overall market. And this is definitely something you should keep in mind when looking here at the market in general, focusing on, let's say, single stocks, and then also having a look at the sector within this ETF is listed. Yesterday, for example, other different or something to consider. It's the semiconductor ETF in this case, so XLK, for example. So you look at it, and why do you do that? Well, because AMD just delivered numbers yesterday. We're quite good, quite strong. Now you want to say, okay, if I go long here, what does the overall sector do with this information? So it's definitely something to take into account also from a research perspective. But we go a little too much into the equity space now. I'd first of all like to point out here advantages of ETFs, and then we just want to go straight away into the oil sector, respectively, have a look back in what just happened in April and is currently happening with this strong run higher. By the way, let me just check here the chat box if I'm... that's an interesting question. So can we invest in these ETFs from India? Well, to be honest, I could imagine. I mean, if you can open an account with Admirals from India, which is certainly the case, then there should be no restrictions to invest in these ETFs, if I'm not mistaken. So probably someone from Admirals reach out. This is the next thing. So the last slide will be around here the contact details. So, but you can certainly reach out to Admirals and ask there directly in the service department, send an email or direct contact them via phone. But as of right now, I don't see any reason why you shouldn't be allowed to open an account and trade these ETFs from India. I think this is not limited to any country. But I definitely have to look at the legal documents if there's some, let's call it blacklisted countries. But I don't think that India is on this, let's call it blacklist. So yeah, I just hope that this answers the question. Advantages of ETFs. Let's have a look here. So first of all, I'm not a tax advisor. Very important to know that. But in some cases, I've heard about this also from clients / relatives / friends of mine who are investing in the ETF space. They are saying that by investing some of their funds / part of their portfolio in ETFs, they have better control over some aspects of capital gain taxes, when to pay them. So this is something I just point out here. I put this bullet point right at the top of this slide here, because it's definitely something which is of high interest for many of us, I'd say. So tax and respectively tax efficiency in this context. So this is definitely something to consider. Then something I also pointed out, lower fees, especially when it comes to mutual funds. I have to really laugh really hard. Sorry, because I just mentioned at the beginning that I worked in a bank as a bank clerk. That was in the early 2000s, and we were also offering funds back then. Some of them are not even today. They just went out of business. But the thing is that if I remember the cost structure back then, that was just crazy. You sometimes pay 5% of your invested amount right at the moment when you bought the fund. So let's say you bought it for 100, or you wanted to buy it for 100. Your price where you got filled on this order was 95. So and then you needed to make obviously more than 5% to break even, and then taking it from there and hopefully making a good return on investment in the long run. So compared to ETFs, this is very, very expensive. So 5% is very, very expensive. There's also one of the points which is sometimes mentioned when it comes to trading FX, for example. If you talk to someone who is really completely new to this matter and wonders what is this FX trading because it's so unattractive, and then he recalls his experiences at the airport when seeing the exchange rates here, and he can't really believe that right now we are paying a fractional pips in this context, so it's 0.2 pip spread, for example, instead of 100, 200 pip spread when it comes to exchanging euro against US dollar, for example. It's very similar when it comes to ETFs and the comparison in terms of fees when it comes here to mutual funds. In addition to that, it's also very liquid. So what you can do is really you can trade in and out these ETFs. I mean, certainly depends on which ETF we are looking at and the volume. It's the same as with stocks. So if you're trading an Apple stock, for example, well, certainly you have high volume within the stock and you have tight spreads and thus very quick and good order execution. Not that much slippage within your trades, depending certainly on when you trade the stock, but all in all, this is something to consider. In case of highly liquid ETFs like Spider, Qs, and also on and so forth, this is also true. When we talk about low float stocks, certainly the spreads are wider. This is the same as with trading major FX pairs against minor FX pairs, for example. So you have a tighter spread on Euro USD compared to, let's say, GBP against New Zealand dollar, for example. So this is also something, but all in all, we have a highly liquid environment here. And this gives us as investors, also traders, gives us the flexibility here to trade the ETF every time during the times when the stock exchange is open and the ETF is tradable. And here are also something which is very interesting. So trading transactions. Since we have ETFs, you can trade these ETFs here like a stock with the same options in terms of different order types here. So limit orders, stop loss orders, buy on margin orders, and so on and so forth. And this is something which is not available when it comes to mutual funds. So which is also something to consider here. And then there's also something very careful, don't misunderstand that. I write here lower risk. So lower risk in this context means that when you invest in an ETF, you usually invest in a variety of stocks or commodities or currencies or whatever. And you have then something we refer to as broad diversification. And this is something which reduces your so-called beta risk. So it's not alpha, but it's the beta risk we are taking out here. So, or to put it differently, you have, let's say, a high beta stock, like a tech stock, let's say Tesla or something like that. And the thing is now, if you only invest, if you put all your eggs in this one basket, you certainly are tied to the overall performance and thus the volatility in the price developments in a Tesla stock. But if you take Tesla, beside of that, you also invest some of your funds in NVIDIA, let's say Microsoft, some in Google, some in Amazon, for example, you're still very tech related, but you have a broader broader portfolio, and you reduce your so-called beta risk. So this is what we refer to, or what I talk about when I talk about lower risk. So it dampens the overall volatility within your equity curve. And so that's it around the introduction. I'm sorry, that was like a little longer. as initially planned, but I think still, I hope I add some value. Let me just do one thing here, by the way. I just have to, you probably remember, I have to get some data on the upcoming US market opening. Today is an interesting day because this is also something which is of interest here from a global macro perspective. We have the Fed in the evening and her announcement around the upcoming monetary policy. And still, I'd like to be prepared here for some single stocks. I currently focus on these Chinese ADRs, where JD, which I already mentioned, but also PDD are quite interesting right now. I think risk reward wise, when we look at it from the recent sellout, in fact. So yesterday I had them already on the on my screen, but there were no trading opportunities within them since the selling pressure continued. But now it seems as if they have at least short-term bottom, and this could be interesting from risk reward perspective. But let's have a look now at oil again. So negative oil prices. What happened? Some of you probably remember price of WTI oil futures with the delivery in May 2020, and they were settled in April, 1 month earlier. They settled around minus 40 USD per barrel. And this is something which was, I've never seen that before, and I wasn't alone. I know that some traders burned massively their fingers here by saying oil prices can't drop below zero. This is impossible. Well, the thing is, it was possible, and I will explain how it was possible. It was very similar to what happened to yields, where macro investors 5 or 6 years ago said it can't be that yields turn negative. It's possible. And this is something we always should keep in mind when it comes to trying to predict what could happen in the market, or what is rational, what isn't. So in the aftermath, we were capable of telling what happened. So roughly speaking was that we had the main focus on the coronavirus pandemic and the resulting global lockdown. So that was what drove markets back then in April 2020. And the lockdown here resulted in demand hitting really rock bottom. So there was no demand for oil anymore. I don't need oil. While on the other hand, we saw that storage tanks really filled up. And that being said, companies then paid traders, speculators, investors, however, they paid them to take oil off their hands with not having any capacity left here to store physical oil. So you don't have an opportunity. But you're forced to deliver, or respectively take delivery in this context. It's not that you have to deliver, but you have to take delivery, but you don't have any storage left. So that's then, and you say, well, I really, what shall I do with it? So I was thinking about, well, taking my pool here and buying some barrels of oil and then storing them, because I could imagine that prices probably shoot higher within the next months here. But all in all, that was the overall logic which played out back then. And that was the reason why you really paid people, and this is the negative oil price, to take the oil off your hands. And since then, still, what we've seen is a massive run higher in oil. So it's not just that oil prices recovered from negative territory here, but in fact rallied sharply. So drifted continuously higher. You just look at the chart, oil chart, going back till April 2020. Depends a little on which continuous track you look at, but most of them will somehow show you a zero around this time. Some of you will show you $8. It somehow depends on how the price is calculated. These are, you might now say how it comes that we're talking about minus 40 USD. This is some deeper understanding we need to have around the futures and here in this contract delivery month, as I pointed out. So if you look at the May contract in this context, you could see it at minus 40%. Well, for example, the December contract, I don't know, it's traded something around $20 probably or so. And then you see different delivery months, and you calculate the price based on it and roll over and the cost of carry in this context. And thus it's possible that you right now don't see these negative oil prices anymore displaying in your CFD charts where you have this continuous contract then. But let's come back here to this push higher from there. So the thing is that the rally since then, the massive run higher, and currently we are trading above 70 USD per barrel here, is mainly due to production still being restrained, while the ongoing vaccination here against COVID-19 vaccine, as of now at least, results in a clear trend back towards normal. At least that was what people thought would happen. Let's see if this plays out. Right now, it doesn't look at us as if we ever will go back to normal. But the thing is that this rise in consumption here, and in addition with the monetary stimulus from the Fed in this context, and inflation fears really picking up, and also right now the travel season picking up, all this leads to higher oil prices and continuous rise. And this thing around this topic now with oil is that it's very likely that this continues. I really could imagine inflation not just being transitory or not being transitory, but permanent higher. But in addition to that, also continuously trade higher. And this context here, also oil prices should continue to pick up, since there's difficulties to deliver oil here around the globe. Here in this context, we need to, for example, mention something like disruption of supply chains, which are hitting every sector, especially probably the oil sector. Everything is getting more expensive to produce, to sell it. Thus, the producer does the following: he just hands the prices, the elevated prices, directly through to the consumer in this context. And thus, this being said, means that oil has a very high likelihood to continue to trade higher, which brings us now to the question, okay, and where do we want to invest? I mean, if this is the case, and we have already seen a quite run higher, but we also know, some of you probably active traders, and you say, hey, volatility in commodities like oil are very, very elevated, very high sometimes. Is there a way to somehow get this, let's call it high beta risk, respectively? Is there a possibility to get especially the volatility out of your equity curve? And this is then where all the pointed out aspects around ETFs kick in here, and why we want to have a look here. Why we want to have here a look at the three ETFs I mentioned at the beginning. So the first one I'd like to point out here is the iShares STOXX Europe 600 Oil and Gas UCITS ETF. Type in EXH1 on the webpage from admirals.com, so you can find their products, and there, if you click on, well, you can really click on shares or ETFs in this context, and then you have a box where you can search for these ticker symbols here. And so what I did here is I screenshotted from an external website, in fact from iShares. So I haven't pointed out the source here. If I'm not, no, I can see it. So I have no link here, but you can in fact just Google it and then find it yourself. And there I get the following data here. So you have the total return percentage, for example. So as you can see, as of May 31st, 21, for the last 12 months, as you can see here, we had an average return of 25.87%, driven by the current run higher in oil. The last 3 years, this doesn't look so promising. So we come from way more north, but around the current levels, around $75 to $80. But make long things short, so we have an overall investment here in stocks with focus on energy in Europe. So this is definitely something to take into account. And also you can see here, when you look at the top 10 holdings in this context, for example, you see, for example, Total Energies here is the French company in this context. You see BP, you see Royal Dutch Shell, you see Vestas, for example. So this is Denmark. You see Eni is Italian. You see Neste, I think so. It's Finland here, for example. You see Equinor. Equinor is obviously Norway. You can also see Repsol. This is Spain. You can see Siemens. This is German. But you can also see here Snam, for example. It's also Italian. And so it's around companies in the energy sector, oil sector here in Europe. And what the fund does, it replicates, in fact, the performance of the index by purchasing all of the index constituents. And the iShares STOXX Europe 600 oil gas UCITS ETF. It's a very large ETF, in fact, which is very interesting. And remember that large ETFs. So in this case, with a fund volume of 1.8 billion euros, that means it's highly liquid. You can really be sure that the overall liquidity will be given anytime, which means you can really trade in, trade out. But it's also something you probably don't agree with me. So you probably say, well, Nance, it's nice that you say all this, but I don't agree that oil prices continue to higher. I'd want to trade short, to trade the short side, which is also possible because you can trade the ECFD on this ETF here, and you can trade it with any without any big restrictions here from the short side, and short sell my idea if you want. And so the thing is, really, it's also interesting from a trading perspective because again, high volume means highly liquid, means you can trade in and out of the ETF anytime here. And so, yeah, we already pointed out the analyzed performance. Let me just check before I scroll into the next slide, let me just have a look here. Okay, there we have it. Okay, so again, if you have any questions, feel free to ask them, please. If you if you haven't yet, subscribe to the YouTube channel from Admirals. Leave a thumb up here, leave a comment in the chat box below. Let us know if there's anything you say. Great, I all the time wanted to hear something about oil, but there's one topic which interests me even more than oil right now. XYZ, leave a comment in the chat box below. Let us know what you want to hear and we produce it for you, no problem. Okay, so far, no questions. Let me just have a look here. Okay, let's come back to the presentation. Let's come back here to the next ETF I'd like to point out. And here we have, again, iShares, and here it's the Oil and Gas Exploration and Productions UCITS ETF. It's IOGP. Again, here, as you can see, performance is even better over the last 6 months. Crazy performance, obviously, over 60%. Still, on the last 3 years, the fund is down. Something which is of interest here is 10-year. So the fund obviously was established after 2010. This is something to take into account here when it comes to your overall decision. If you want to invest with something which is already in the market, let's say for 20 years, then you should also take into account how long here the performance history you can find. As you can see here, it's not concentrated on Europe in this context, but it's concentrated around the world. In fact, you have here Canadian Natural Resources, CA. You have EOG Resources, it's from the US. You have ConocoPhillips here, also from the US. You have Pioneer Natural, also US, very US related, but also here, as you can see, Australian with Woodside Petroleum, for example, you can find it here, or Santios at the end. So long thing short, it's an ETF here, oil and gas exploration, which is investing in energy around the world. It's very interesting that I point these out because remember, we also had some webinars in the past, hot topic webinars, and when it came to electric vehicles, respectively, renewable energy in general. And I already pointed out that I'm a big fan of this, and it plays a very important role in my overall vision for the future. So where are we headed? So this is something which is very important for everyone, in fact, who wants to also invest. The first question I answer in this context for myself is, when I look at my overall picture of the world, what picture do I see in the future? What resources will be needed to fulfill this vision of the future I have? And then based on that, take my investment decisions here and invest in the certain areas. And I have to admit, I mean, even if renewable energy plays a very important role, and therefore you just need to follow the news around the globe. I mean, everyone is talking about climate change right now. Everyone is talking about green energy. Everyone is talking about, let's put it even lower to some extent. Everyone is talking about Tesla. So everyone is talking about electric vehicles. Many people are talking certainly about companies like Tesla due to the massive run higher we have seen over the last years, and the massive growth outlook. Also, you just have to look up the earnings report they just released, the crushing numbers. It's surprising that we didn't see any aggressive push higher here in the share price and no push back above 700, but probably most of it was already priced in. Still, I see a longer term overall positive outlook for electric vehicles / Tesla, especially due to this outlook for the future. But I have also admit that also oil, gas exploration in this context plays a very important role, because I mean, while everyone is focusing on the climate change right now, we also have to see, well, right now we have 7-8 billion people around the globe, and all of them are in need of energy. So here in Germany, people are going crazy. I think we can somehow influence the overall global climate. This is ridiculous. And some people say, well, there will be a day once there will be a switch back to, let's call it a fossil energy or classic energy sources like oil and gas in this context, and something to take into account. And this is something which is also playing a role when it comes to demand. I mean, just look where oil is needed all in all. So it's not that you say, oh, great, I see some climate change headlines, and thus we will have these climate change developments. Most of it, in my personal opinion at least, is that it's politically driven, and the people discussing this, they discuss it for a reason. So it's not that I don't believe in climate change or something like that. Not even close to. I really think that this is something which is one of the big topics of our daily lives, and also for the future here. And I'm certainly here looking for investment opportunities and areas where I think they will naturally result in a world or developments around the world in which I'd like to see my children grow up in. But still, beside of this, let's call it romantic aspect, still there's also something we need to remember in this context. 7 to 8 billion people, and you just can't just say we now focus only and exclusively on green energy, but this goes step by step, and oil and gas will, for some years, probably even a decade and longer than that, play a very important role in our overall lives in this context. So this is one of the reasons. Some of you probably have seen earlier webinars with me, and I just wonder now, oil, gas exploration, what's up with this guy? So he was talking about green energy 3 weeks ago, and today we are focusing on oil and gas. It's not it's not a how can we say that? In Germany we call this Widerspruch. It's like it's not counterintuitive, let's say. So it's also pointing the same direction, and it plays also a role in something, even though it's not outweighed oil and gas exploration, but definitely something to keep an eye on and think about. Again, also here, the fund, let's come back to the fund, replicates the performance of index by purchasing the index constitutions. And here also, and this is something which is also something to consider, again, 1 billion earlier in the ETF, so very, very liquid in this context. I mean, still, we have an invested volume here of 189 million euros, but still, it's way below 1/10 of what we just saw in the earlier, even though it's also, well, it's not also, but it's investing globally in this context. And this is also, by the way, probably something which is then resulting in this annualized performance. So the broader ETF invests, the less volatile the constituents of the ETF in this context, and then potentially also the lower the overall risk, because there you can see that you have, on the one hand, one-year performance of over 60%. On the other hand, you also have some quite volatile swings sometimes within your equity curve, something you want to avoid, especially if you look at it from a longer-term perspective. And so finally, let's have a look here at the Lyxor STOXX. I don't know. I think so. Yes, I haven't checked it, because so the next one asking now if we accept signups from Nepal. I'm not really sure if there's any restrictions to customers from Nepal. I could imagine there are not, but I don't know. I don't know. You just check out admirals.com for further info on if you're allowed to open an account. But I have to really say, I know as a German, yes, you're allowed to. UK residents are also allowed to. It depends on the regulatory body you then open the account with, but still, this is something beyond my reach. I'm sorry. 1 second, by the way, just 1 second. I just have to close the door. Okay, so here I am again. Let's have a look here now at the last ETF. So the Lyxor STOXX Europe 600 oil and gas UCITS ETF. It's a little bigger, as we will see. And what we have here is, again, a focus on Europe. So we have BP, as I pointed out already earlier. So you probably have seen these stocks in the ETF earlier. So the companies are very similar to the ones before. And what the fund does is, in fact, or the index in this context does, it synthetically replicates the fund through financial swaps. We don't want to dig too deep into this matter, but these are derivatives which could cause some trouble if there's some heavier volatility hitting the markets, and could result in some heavier volatility swings, let's say, in this context, in the overall equity curve, which is one of the reasons, if I look at here at these constituents, that I'd like to focus here on the one I mentioned at the beginning, the EXH1 ETF in this context. And so the fund volume, as you can see here, 335 million, quite good, liquid, and still, as you can see here, this is the analyzed performance at the bottom. And there you can see that from June, for example, till June 21, here we had only a performance, an annualized performance of 12.6%. And what's very interesting is that the year earlier here, we had a performance of minus 20%, mainly due to the massive drop, as we have seen it in oil, especially around Corona and COVID in this context. So it's covering, or here, taking these volatile and heavy, massively volatile moves into account. But to make long thing short, also something to probably take into account, even though if I had to decide now between the EXH1 and the oil, so this is the ticker symbol here on the website from Admirals, I'd most likely go with the first one, due to the aspect that here it replicates, synthetically replicates here the fund through financial swaps. This is something which could cause trouble if volatility really hits and picks up, and something you want to avoid in terms of volatility in your overall equity curve. And so finally, we come to the overall summary. So first of all, ETF is short for exchange traded fund, a group of securities you can buy or sell via stock exchange, as pointed out at the beginning. And what ETFs do is they offer a range of asset classes consisting of a group of, for example, traditional listed companies, but also currencies or commodities like oil. And then one of the advantages of ETFs is the lower risk. What I mean with lower risk is that you have, due to the broader diversification here, a lower so-called beta risk. So since you're investing in more than only just one company, the interesting aspect about what I just mentioned is that you have companies here which are also potentially paying dividends. It depends on whether they pay them out or they reinvest them. But all in all, this is also something which probably longer-term investors look for when it comes to the overall cash flow component, and something to consider based on your personal risk profile and your overall investment needs, respectively, what you demand, what you look for. Something to take into account also, and why, again, and this is then summing it up quite nicely, why ETFs are very interesting for a broad range of investors who are looking not just for broader diversification, lower volatility in their activity curve, but also want to see certain investment needs being fulfilled. And as I pointed out, the interesting investment opportunities at Admirals are the ones I just pointed out. So the iShares STOXX Europe 600 oil and gas UCITS ETF, EXH1, my personal favorite, but this is just a personal story. Then we have the iShares oil and gas exploration and production UCITS ETF, the IOGP. And then we have here the last one, the Lyxor STOXX Europe 600 oil and gas UCITS ETF. short one, ticker symbol is oil, if you want to look it up and the details around it on the website from Admirals. And oh, there we go. So next webinar, my dear colleague Paul will be here, Paul Wallace, and we'll talk to you about the trading or how to trade the 3-bar breakout here, including in this context, what, first of all, is it? So the definition of the 3-bar breakout and what are the best market conditions to use it then within, and also how you can build it within or into your overall trading plan. Which time? 2 p.m. London, as today on Friday, 30th of July. Check your inbox for the webinar link. And if you watch this now on YouTube, again, not just subscribe to the YouTube channel, leave a thumb up here, but also head over to admirals.com and there to the webinar and educations tab. And there you can register for this free webinar and ask Paul all your questions around the trading 3-bar breakout questions you might have. And now for everyone who just wants to find out more about Admirals, here, feel free to check out the website, admirals.com. Send an email, global@admiralmarkets.com. YouTube channel, subscribe already, so no need to worry about this anymore. If not, hit the subscribe button. And so that's it from my end. Here's the risk disclaimer, fully regulated broker. I wish you all the best and happy trading. Watch your stops. Talk to you next week again.